Today we are going to speak about volatility. Trading success requires understanding volatility, along with the option spread that are suitable for different volatility environments. There are two types of volatility: statistical volatility and implied volatility. Statistical volatility is also known as historical volatility. It's a measure of how much the underlying futures has moved. Statistical volatility can be computed in different ways. Two commonly used methods are the close-to-close approach and the extreme value method. The former uses only closing prices, while the latter takes highs and lows into account. Here is shown a screenshot from my trading platform, and you can see that historical volatility is computed using close-to-close approach. Also, historical volatility computed over a specific time period will likely be different if computed over a longer short period. Then there is implied volatility. Implied volatility is a trader's best guess as to what statistical volatility will be in the future. This is very important because each trader must input his implied volatility forecast into an option software program to determine if options are fairly valued, undervalued, or overvalued. And as a trader, you want to obtain a trading edge by buying options when they are undervalued and selling options when they are overvalued. In this chart, you can see historical, the violet line, and implied volatility, the red line, for December futures on wheat. And with green arrows, I show you an opportunities to buy options when options price is lower. And the red arrows shows you opportunities to sell options when options premiums are high. You need to track implied volatility or work with a broker who tracks it, because you don't want to buy options when they are expensive, when implied volatility is high. For example, in here, it's better to sell options than to buy at this point. And for any commodity, if you look to a graph of statistical volatility superimposed upon its graph of implied volatility, you will see they frequently diverge from one another. That's because traders' expectations for implied volatility are forward-looking and are not tied to what's happened in the past. Different traders will come up with different forecasts for implied volatility because their expectations for what the market will do are different from other traders' expectations. Option traders will inflate both put and call premiums when they get emotion and expect big things will happen. This is common true for agricultural markets, because every time when traders expect the crop to be damaged by bad weather, implied volatility always increases. And of course, traders will bring down premiums when uncertainty wanes and they become complacent. So, once again, options prices or premiums expand when implied volatility rises, and they shrink when implied volatility drops. So when emotional reactions overshoot reality, there is an opportunity to capture expensive premiums by selling overvalued options, selling volatility, and the opportunity is to buy undervalued options when market participants get complacent about a market's prospects. In both cases, you really don't need to predict the market. Just trade your expectations about implied volatility. How to do it will be shown in this course.